new lows. Out of the 25,000 people who answered the poll, 70%. I then said, how many of you are underweight versus your normal equity weighting? 75%. And then we look at the BOA survey that is as bearish as it's max bearish for 9 possible weeks, and the market is just ripping in a straight line. And that's telling us still nobody's participating. So I've labeled this the most hated rally. It's the same in crypto, same in macro. These rallies are utterly hated. There's a narratives the market is tied to. It's tied to, and I think you and I share all of these. I think it's tied to oil is going up only. It's going to $200. Inflation is going to be super sticky. Equities are going to go to new lows. Crypto is going to go to new lows, and bonds are dead money. And I just very much like the other side of that. Out before by soft landings. 2016 was one of those. 2015, 16, that whole period. I don't see it. My macro data is very clear that we should be going much, much lower. But I got caught out in 2016. It was the dollar back then that was looking like it was going to push the global economy off the cliff. Many economies went into recession. The US didn't. I think that the economic damage from rates, the dollar, inflation is done. But what's confusing people is the market's job is to look kind of a year or 18 months forward and think, what are the conditions? Well, even if it's 6 months forward, what are the conditions in 6 months' time? This is kind of the Stan Druckenmiller argument. The conditions in 6 months' time, if we're all right that a recession is coming, well, rates are much lower. And if we're wrong, and it's a soft landing, equities go higher. So in all outcomes, equities go higher. So it's a matter of where was the low. So my view is we go into recession. It's pretty nasty. It's pretty quick. And the bond market's right to start pricing in a change in Fed policy at the turn of the year. They'll probably go on pause beforehand, by which case, and again, you've been tweeting about this and I've been tweeting about it. All of our work both suggests that the ISM is going to go hurtling through 50 in the next 2 to 3 months, which people aren't really prepared for. Trying to tell people they kind of know, but I don't think they are. So I think they're going to try and sell equities on it when it comes out, and that's probably going to be a very big mistake because equities because the bond market's kind of telling us what needs to happen. But there's still a few factors in place that aren't fully in place. I think both you and I would love to see the oil market sort of break these $85 level, because I think it comes down to about 60. Then the year-on-year rate of change would be negative 50%. I think we get negative inflation in 18 months' time. And then we also want bonds to really properly break this kind of 260 level in terms of yield, because then I think it opens it up to 2%, 1.5%, 1%, depending on how deep the recession is. So I've got to put up a chart that Julian Bittle put together for me at GMI, which is the year-on-year rate of change of all the asset prices against the ISM currently and against where our forward ISM is based on financial conditions. The forward ISM goes down to 40 and bounces. It would suggest it's a 9-month lead. It would suggest that ISM starts bouncing in Feb or March next year. So we've got the worst to come. Now, if you rank all the asset classes, what I call exponential age stocks, which are the further out growth names, were pricing ISM at 38 or 37. So they were super pricing in a recession, excess pricing in. NASDAQ was about 42. S&P, wherever you've got it, it's 40 something, 45, 44. Mm-hmm. And then bonds were at 63. It's like, wow. Now, it's happened a couple of times before. Once was 2008. And I think it was again, not sure when the other period was, but it has happened. And the outcome is always that bond yields utterly collapse because they get stuck with the inflation narrative for a while. And then eventually that narrative flips as the growth narrative comes. Usually it's when the ISM crosses 50, bond market goes, I'm sorry, we got that bit wrong. The Eurodollar market's been much smarter. It's like, no, you bond market guys, you got this wrong. They're going to have to be cutting rates. But the bond market's still struggling to try and decide is